Options markets rely on market makers to fill orders submitted by end investors and traders. These are highly sophisticated, technology-driven companies that, at speeds now measured in nanoseconds, are updating the bid-ask and taking the other sides of trades in the hundreds of thousands of different options listed at any given moment in the United States. So, given the utmost importance of these firms, we dove into their evolution and their operations in this episode of Tales of the Tape. Joining me from Cboe is Andy Bevers, head of derivative sales for our U.S. members, in a conversation with Steve Crutchfield of market-making firm Chicago Trading Company, or CTC. Hope you enjoy this far-ranging conversation. Steve, you've had an interesting background. You've been on a couple different sides of the trading coin, so to speak, different places in the industry. Andy, you have a unique kind of twist on what I'll call a prototypical meet-cute story. So I was hoping we can start with you, Steve. Just kind of give us that LinkedIn CV, but more fun.
Yeah, unfortunately, I don't have a meet-cute story because I think that's what we all aspire to professionally. So I started my career here. Well, not actually here because Cboe was across the street at the time. But I began as a clerk on the floor of the Cboe, as one did in Chicago and in the 90s. It was a heady time, and picture the sounds of the Spice Girls wafting through the air on LaSalle Street or something. I don't know, that's not what I listen to, but it's popular.
No judgment.
But I remember vividly. So I had the opportunity to do an internship on the floor of the Cboe through a friend of the family, which, by the way, I think at that time, that was how everybody got their internships on the floor of the Cboe. Like, you know a guy who knows a guy. And I remember my first time in the visitors gallery across the street, looking down and seeing that, what the media invariably refers to as the sea of brightly colored jackets, but it was this organized chaos. Maybe not that well organized. But I remember watching and thinking, like, I got to be a part of this. I got to figure this out. There's like, these people are doing something that has some meaning, presumably. I was kind of hooked. So it was actually the floor that hooked me. I think it pretty rapidly emerged that I had neither the patience nor the temperament to be a really good floor trader, unlike many of the fine ladies and gentlemen standing behind me who do an excellent job at that. So off-floor trading as a thing was really just getting going at the time. So I became our first off-floor trader. The company I worked for was called Cboe Capital Management, which was a great shop, sadly no longer around, but became a major DPM firm at the time. So designated primary market maker here on the Cboe floor. I helped build that off-floor trading business, and after a couple of years, sort of segued into trading technology, meaning electronic trading was really just getting going in options with the launch of the ISE in 2000. Cboe moved on to what was called the hybrid platform. So the initial Cboe electronic trading and quoting platform back in the day. Somebody realized that I had a master's degree in computer science, maybe gathering dust on a shelf or something. And they said, like, hey, we got these programmers. Could you kind of lead that team and help them to build something that we could use to actually trade? And so we built an automated quoting platform, one of the first. It became known as Brisk, which eventually was sold to B of A some years later when they acquired our clearing firm. And actually that platform remained in use for a shockingly long period of time. I'm not even sure it was good. But
apparently it was.
Apparently it was okay. I think they kept it alive until about 2012, 2013, something like that. But just during that brief period, and then I'll get back to the LinkedIn meet cute, but there was a fascinating development of the type of technology that was used. I'll even say during the first 4 years of that period, from like, I said 99, it really was 98 really, and I started my internship in 97, but so it was the late 90s, between like 97 and 2001, when the ICE 2002, when the ISE was really established. When I started as a floor clerk, the technology that we used was basically a calculator. It was a little machine with a screen that was about 6 inches by 3 inches. And part of my job as a clerk, it wasn't connected to anything. Part of my job as a clerk was to enter the stock prices so that the theoretical values would update.
Yeah.
And then we had a Cboe handheld, which we could use to kind of cart up trades. But there was no there was no pricing or quoting going on there. That literally all you were doing was taking trades you already
Trading.
made,
Yeah,
right,
yeah.
and putting into the system. That was in about 97, 98. By 2001, market makers were running full scale quoting stacks, making markets electronically on the ISE, and by 2003 doing the same thing on the Cboe. So anyway, back to your question. So I did some trading. I ran a technology group. I ended up at a company called Matlock Capital, which I think is your favorite name for a trading firm.
I've got a lot of other favorite names. There's a lot of great stories about names. I always think of Aardvark, just going with two A's just to get at the top of the directory for anyway. Yeah, exactly.
Matlock Capital was I was asked if that was an Andy Griffith reference, and it was not, unfortunately. But kidding aside, Blair Hall's firm, wonderful guy, great boss, a mentor, absolute legend in the industry. So after he left Hall Trading, he started Matlock Capital. I was the COO there. So we built, again, a slightly less early, but very early electronic trading group. Did that for a number of years. Had the opportunity in 2009, beginning in 2010, to take on a newly created role at the Amex. So the American Stock Exchange at that time, options business was being sold to NYSE. They wanted to bring in an external CEO. That became my job. So I was the CEO there at the Amex for a number of years, became integrated into the New York Stock Exchange, where I was part of the leadership team, ran the options business along with the ETF business and some other things we had going on there. Bond trading, the global index group, kind of the non-stock trading stuff at the New York Stock Exchange, basically.
Everything but.
It was my purview,
The island of misfit toys. Just send it to the options guy.
Give it to that guy.
There's actually some shirts, and it was great. By the way, a great experience there, working with wonderful people.
I say that out of love.
Both, yes, of course. And both, before and post the acquisition by ICE, who bought that business in 2013, might have closed the deal in the beginning of 14. So it was a great experience. But certainly that was a stock focused company. And it is true that although we had, and NYSE still has, a large options exchange business, there was a little bit of an element of like the other stuff can kind of go with the options guy. I think that is true. And my friends at NYSE would probably not disagree with that. Anyway, my story is running the risk of being overly long. So to wrap it up, I joined CTC in 2016, not quite 10 years there, worn a variety of hats. Great to be back home in Chicago. And we are a big part of the community here on the Cboe, and it's an important part of how we do business.
A little bit of the overlap, Andy. You maybe didn't have the demeanor nor the patience for the floor as well, but yet you spent some time there. Is that you're giving
that's
me
true.
dagger eyes?
No. That's spot on. So I was in the Marines, and I was discharged, applied to college, had a summer to burn. So was trying to figure out what my next move was going to be. I have a twin brother who is a clerk in the OEX at the time, and he was like, "Hey, come down to the floor, see what's down here for you." So I literally came down fully intending to spend one enlightened summer getting some experience in the business. And literally the first firm, he got me on the trading floor. I walked booth to booth, firm to firm. The first firm that I engaged with, I was like, "Hey, you guys looking for anyone?" They're like, "We actually are. Can you start tomorrow?" I'm like, "Let me check my calendar. I'm good. I will be here tomorrow." And next thing you know, so that was with a small Chicago-based broker-dealer, First Options of Chicago, cleared business for a lot of the market maker community. First Options got acquired by Spearlead. Spearlead gets acquired by Goldman. Next thing you know, I'm a Goldman employee. So worked for Goldman for 24 and a half years. Similar to Steve, started on the trading desk as an order-taking clerk for all the market makers that wanted to move quotes on away exchanges in order to be able to print trades down here. So I did that for a period of time. And by the end of that summer, they'd already put me on a seat. So I was ready to leave and go to school. My boss pulled me aside and said, "Hey, you've got an affinity for the business. Would you consider foregoing school and sticking it out here?" And he threw some money at me. And next thing you know, there it is. And here I am. So I'm very similar to Steve, right? I spent probably 5 years as a broker in the multi-list pits on the Cboe floor. I kind of saw where the business was going, right? You heard a lot of buzz later in the 90s around, the pivot to electronic, and it's coming, it's coming, it's coming. Seemed like it never came. Then, like Steve alluded to, right? The ICE comes to pass in 2000, sharp pivot to electronic. Everyone kind of accounts for that. And at that point, I had an opportunity from the Goldman side to move off floor. Goldman owned Ready Plus at the time, a pretty widely adopted OMS EMS. So I had the opportunity to go upstairs and cover the institutional clients, the market makers that were utilizing that infrastructure for us. And that's kind of how all things led here to Cboe. I always had really strong relationships with the market maker community. That was kind of what my mandate was at Goldman. So in 2019, had the opportunity to come over to Cboe, covering all the market makers from the exchange perspective. So I deal with Steve and the like on the regular.
Much to his chagrin.
Yes.
Yeah.
So you both touched on the like early tech bit, and I mean like, the whole calculator, which essentially was just the first move past a sheet, is kind of what it sounds like. But then moving past that, since you mentioned the EMS, OEMS, and then you mentioned building a few kind of early, like, pull the thread for me, Will. Like when would you start calling something like a market maker's tech stack, or like when would you start kind of applying the descriptions or the terms that you might hear describing what's happening behind us? If I'm phrasing this awfully, but do you kind of know where I'm heading there? Like if you could kind of trace this evolution from, oh, okay, like we're just kind of trying to put what's happening in our brains into a machine versus this is like this automated quote machine that we need people with not dusty computer science degrees to build and maintain. And then, I'll have you chime in on like selling it and what, you had to educate people on, et cetera. But
it's a great question. It turns out, by the way, my computer science degree only gets more dusty over time. I try to keep up, but it's
what were
hard.
you being taught? Yeah.
It was C++, but it turns out that C++ is not the same as it was in.
Gotcha.
And this is before C++ 98. It was, it's actually a great question. I mean, we both mentioned now a couple of times the launch of ISE. It's hard to overstate the importance of that event, the options trading in the United States. Like a lot of the market structure that we have today, for good or for ill, really traces itself back to that era right around 2000 to 2003 when ISE started trading electronically. And by the way, it was met with a lot of eye rolls. I mean, I in this building, but probably by myself at one point from colleagues. At one point, the ISE was a place you could go to get a one lot done at the price on the screen, and it was kind of a joke, right? Like, hey, it's on ICE. You're not going to get a fill. Why are you wasting your time? Oh, look, you got a one lot. But shockingly quickly, first of all, that changed, right? It became a real source of liquidity. Then when other exchanges followed suit, I think Cboe was right at the vanguard at the time behind, once ISE sort of exceeded the proof of concept. But we saw spreads come in. This was around the same time, of course, as what at the time we called decimalization, the move from trading in eighths, quarters, and teenies to trading in dimes, nickels, and pennies. So spreads collapsed and tightened. Quotes became immediately available for electronic execution to a much greater extent than had been the case. In the 90s, you could get a 10 lot done on a raise, which was a retail execution system if you were a true retail customer. But by the 2000s, these quotes were available for anyone, with exceptions. So, the trading landscape really changed quickly. And as part of that, we saw, the evolution of an electronic market away from the floors, although the floors, I'm happy to report, are very much still here, which might be another point that we'll come back to. But, that was kind of the story. And by the way, when that happened, and most importantly, we saw an absolute explosion of volume. So options volume, I don't have the numbers in front of me. You may know them, but in that era after 2000, we saw the first really big upswing in listed options.
Well, it just opened up, truth be told, another channel of access to the markets, right?
That's right. And for anybody looking for, a quick execution, by the way, execution costs came way down at the same time. We had $2 brokers, executing kind of everything. And then, they still played a role later on, but So we saw markets get a lot more efficient. So back to where you were going. It's during that time that the idea of a market making system evolved from, we used microhead in 1999, and it was, again, it was basically a big calculator, right? You could see the prices on the screen, but the purpose of looking on the screen was so that when a guy called me on the phone, I could type in the thing into my microhedge and it would tell me that option's worth 93 cents. And 5 years later, it was no. The thing I'm looking at on the screen is actually the thing streaming quotes to the market. And quickly then we moved from there to kind of, fortunately or unfortunately, and I think it's a mixed bag, but the technology arms race began with improved execution quality, reduced execution time. Everything got faster and faster. But along with that, which topic maybe we'll come back to, the barriers to entry to this business just absolutely blew up. Where when we started our careers, guy could get some training, few months maybe, go to the floor, you're a market maker. You might not be a very good one, but you're a market maker, or you might be the best market maker on the floor.
Yeah.
And it was really a kind of a meritocracy of skill in pricing options quickly. 10 years later, you're now looking at 7 figures, and today you're looking at 8 figures of upfront investment to just to get in the door and be able to play the game.
And that's, to your point, that's just to start a bit. That's not to maintain. That's not necessarily even talking about connectivity. And if you're going to scale, and then I need a new port, and then, I got to start, and then you start, next thing you know, you're buying radio towers in France or whatever
that's getting
you
your
guys
foot in the door.
Yeah,
that's
right. That's just getting your foot in the door. It's finding that old tower in Normandy or whatever.
I haven't heard that. I'm gonna look into that. Maybe that's our prop.
Secret sauce.
Yeah. You're not using those. Hey, this is old news. That Sniper and Mawa blog, Bob Van Zant or whatever. Yeah, I learned a lot.
Van Valsa.
Yes. I don't know where he's at now, but he used to be a son.
Now I have to make a quick remark about Bob Van Valsa, and I hope that he will somehow hear this. I knew Bob Van Valsa because when I was in high school, he was the guy who ran the computer lab at my high school.
Oh, no kidding.
Before any of this, before the Sniper and Mawa, yes. So
everything's connected,
yeah,
Spencer.
That's right.
Everything's connected.
I mean, it really is.
Years later, I saw his name on this thing. I'm like, wait a minute. The guy from the computer lab? Yeah.
That's
It
the same guy.
all comes back to trading.
That's right.
Do you remember how much, this isn't proprietary, how much was, when you were selling Ready, to a person, do you remember how much it was? Just on adjusted for inflation.
It was like anything else, right? We had per user.
Okay. It was all convoluted
fees
pricing
and then
tiers.
enterprise pricing. But back then it was interesting, right? Because we had a lot of, going back to the pivot to electronic, right? Everyone had to kind of reorient themselves to being able to trade electronically. So really what Ready did, and Goldman was really the impetus for that when they bought Ready Plus, was develop a full algo stack, right? So allowing people to intelligently engage with the markets using our proprietary algos rather than just point and click versus the screen. So that was where the real value was.
Okay, so then it kind of pivoted. You're gearing more towards, all right, we've got this electronic. How am I executing? How am I engaging with that? And then I think then you can kind of maybe track the iterations since, but that's kind of the sea change to you. Okay. And as they say in the options industry, ICE, but not to be confused with the ICE that other people might be familiar with. It took me a while to do that. I was like, and then Intercontinental bought NYSE. Just makes everything even more confusing.
I will say, because this is a critical point that we should spend a lot of time on. I certainly grew up referring to the International Securities Exchange, now part of NASDAQ, as ICE.
Okay.
Then I took a job at the New York Stock Exchange. Then the Intercontinental Exchange, ICE, bought the New York Stock Exchange. And it was very quickly hammered into me, no, we are ICE. They are the ISE. And since then, I have to say ISE. I can't not say ISE.
It's just
when I'm
embedded.
talking about that. That's right.
Well, I'll make sure that Gary Katz gets a copy of this podcast sent directly to wherever he might be these days. So kind of to the activity that your current firm is engaged in and the people that you interact with on a day-to-day basis, for good or ill. we say provide liquidity. We talk in kind of, I feel like these amorphous terms. And I think people get what that means, right? It's like, I'm not going to the market and there's one other person on the other side of that wants to buy the Apple call that I'm selling, right? There's this group of individuals or companies that make this happen. But like, from your perspective, kind of, I'm hoping to demystify this provide liquidity type of phrase. Like, what does this actually look like from a business perspective?
Sure. So, I had the opportunity to speak along with some of Cboe senior management, a couple other exchanges in Washington last month, and this is one of the topics that we talked about. And so I'll begin here with the same thing I said to them, which is, so we're talking about liquidity providing or market making. It's what market makers do. And the first thing you need to know is that market makers are the most important people and provide the most important no, I'm kidding. Andy's looking at me.
No, it is true, though. Well, I do. I say it all the time, right? Like, I mean, Cboe provides the technology, the platform, and creates the products. We do nothing as far as quoting. That's all you guys.
That's
right?
no, I mean, right. So
if no one shows up to market,
we got problems.
Nobody can sell their apples. Nobody can buy their apples.
That's right. So kidding aside, right? What we do is we provide the advertisement, right? We put the numbers on the screen that say, hey, world, you can buy this option at this price. You can sell this option at that price. And why is that a good thing to do? So it gets back to what, I don't know, you guys took college econ or whatever, but I remember vividly what my professor called it solves the problem of the double coincidence of once. So it's the whole story of economics is motivated, I guess, in some textbook by, people live on an island. I have coconuts and you have bananas. And, what are we going to do? I really want a coconut. I really want a banana. You have bananas, but I haven't met you. I only know him, and he's only got seashells. So I've got, like, what do we do? So he'll be the middleman, and he'll go find you. He'll take my coconut. He'll get a banana from you, right? And then we can do a trade. And I don't always have to be where you are, know where you are every time I want a banana, because I can go to Andy, right? And he can kind of be the middleman. So that is the role that market makers provide. We are a middleman between investors who want to buy an option and investors who want to sell an option, but not necessarily at the same time. And so that's what we do. We hold the inventory, we warehouse the risk. And that's particularly important in the options markets because, like, the counterexample, it's a little bit of an artificial distinction, but I think a common story that people say in trying to explain this is, if you look at the stock market, right? Apple is one thing. You can buy shares of Apple, you can sell shares. Every day there I don't know, probably millions of people around the world who want to buy and sell shares of Apple for around the same price, around the same time. And so you have a very liquid market. And so we have market makers in stocks, but that role in a way is less critical than it is in the options market where, and I don't know the exact number for Apple, but I would guess there are probably about 1,000 puts and calls listed on Apple at any given point in time. We have about 1 million listed options altogether in the US, roughly. So without a market maker, the chances that one investor happens to want to buy the Apple Jan 2027 550 call at about the same time that somebody else wants to sell that same option, chance of that happening is extremely small, particularly if we're looking at Jan 2027.
Yeah, I was like, you're going straight to a Leaps example? Like, yeah.
So that's the story. So our job and our regulatory obligation, for which we are required to fulfill in exchange for certain, margin relief and other things, is to at all times display what is the bid at which we're willing to buy a large number of options, what is the offer at which we're willing to sell them. And by doing so, we make the market more liquid, stable, and efficient. And that is what we mean by providing liquidity. The technical challenge there, and then I'll stop in a second, but the technical challenge there, getting back to what we were saying earlier, is you imagine doing that for about 1 million listed options in the US on about, 5,000, 6,000 listed stocks, something in that ballpark. And a like number of ETFs now, by the way. I read
more
today,
ETFs.
I read that today.
I saw that.
The number of listed ETFs has exceeded the number of listed stocks for the first time in the history of America. So that's a fascinating fact. But you can imagine quickly there's this exponential increase in number of stocks times number of expiries times number of strikes. times puts and calls. It's a huge number of products. And as a market maker, if we are slow by the tiniest fraction of a second in updating our quotes on any of those, the chance that another professional is going to figure that out and hand us a bad trade is extremely high. And so we've got to build our systems to protect against that in order to be able to fulfill our function as a liquidity provider. And that's the hard part of being a market maker.
Is it safe to assume that it's almost like a 100% given that somebody's going to hit you
It's
on
100%,
that sale quote?
Yes,
Yeah,
absolutely.
yeah.
Yes.
And
Okay.
I say it all the time, right? And it really is true. As a market maker, it's almost become more important at this point to be able to play nimble defense than it is to be able to be really offensive, right?
It's foundational because if you can't play that defense, you're going to lose money.
You're done.
So if you just want to not lose money, you got to have that defense.
Yep.
And then now you have the luxury of figuring out, okay, now how do I make?
Okay, so I guess what I kind of want to get into is your comment about risk warehousing. So I've tried to get to the bottom of this before. It's like, okay, so there are a lot of different market makers, but is it, or maybe just agree or disagree, it's not a commoditized service in a way, but also it's like trying to capture the spread in whatever way I can. Like, is there a style differentiation that you see between types of market makers in terms of how they, because I think, again, demystifying, people are like, oh, every market maker goes home flat.
Right.
And then it's like, well, I don't think that's a nice broad brush you're painting with there.
Yeah.
So I'm curious your perspective on kind of like.
Yeah, that's a great point. Yeah. So, and by the way, let me just amend something I said a second ago. I'm not trying to tell a story about, oh, so woe is me. It's so hard to be a market. I mean, it is. It's expensive, and it's like a lot of things in life. I mean, there are challenges that obviously could be remunerative at the same time, but it certainly is not. It is not a trivial exercise and just like, hey, I'm going to buy the bid and sell the offer all day. And to your point, there are different styles in terms of how one goes about this. So to also paint with a broad brush, I would say there are maybe, I'll start with three. There are kind of three buckets of market making strategies. One is try to just be on the market all the time. So look at the quotes on the screen. They're already there. You wake up in the morning, you can turn on your screens at 9:30 Eastern. There are bids and offers already there. So the simplest thing you might think that you could do is say, well, I'm going to get on those bids and I'm going to get on those offers and I'm going to get my little piece of the action. And I'm going to buy a little bit lower and I'm going to sell a little bit higher and I'll manage my risk and I'll go home flat at the end of the day and I'll make money. So that is a strategy that requires that you be very fast and connected to every market and you never miss a signal because those are tight spreads and you've got to have that defense game down perfectly in order to do that. But those guys exist and they go home pretty flat. And you'll see, take a public firm, Virtu, they talk about that. This is their goal, right? They don't want to have any risk. The other end of the spectrum is much more akin to what we do at CTC, which is we believe our value add is in pricing and risk management. So it's not just about being on the quote. I shouldn't say just, I'm not diminishing those guys. That's hard work. But our strategy is not about just being on the quote. Our strategy is about, well, we think we have a very good sense. We're a quant-driven firm. We know what these things are worth, we believe, within some margin of error. And so our goal is provide a price, even if we woke up at 9:30 in the morning and those screens were dark. Nobody else is out there. We believe that we would have a pretty good sense of, well, here's what these options are worth. I'll throw out a bid a little lower. I'll throw out an offer a little higher. Sometimes I'm going to be wrong, but that'll kind of come out in the walk. And we're prepared if the market disagrees with us, we're prepared to hold some inventory. And there's kind of a spectrum there of like, well, you want to hold that inventory for 10 minutes or 3 days or a month? And the answer is always the shortest possible period of time because we don't just like to have risk on, right? But maybe there's some hedge funds that do, right? But as a market maker, we're trying to always, turn over our inventory, but we are prepared to hold it for a longer period of time. And so that manifests, for example, in our market share, which unlike some of our competitors tends to be higher for longer dated, less liquid options, for example, in the S&P 500 index. So that's the second bucket. the third bucket very broadly is shops that are in the prediction business, which we're not, right? When I say you're pricing options, we're pricing options based on what we think their true best estimate contemporaneous value is, but we're not trying to guess what they're going to be trading for next week. But there are shops that have alphas, volatility forecasts. Again, a lot of hedge funds get into this type of business where actually their bread and butter is, you know what, the VIX is at. I don't know where the VIX is at today, but VIX is wherever it is. Next week, it's going to be 2 handles higher. I want to kind of buy vol. I'm going to selectively pick the right option. I might still be a market maker, but I'm going to have a bias to be more of a buyer.
Got your tilts.
You know, exactly. I got a tilt, and I'm going to try to, you know, hang on tight. So there are others, but I said, look, that's kind of how I divide up the world.
No, that's extreme. That's what I've been driving at with a few people. And, you know, they're like, no. And I think maybe that's the secret sauce element, that they're not willing to go into. And then I guess the third bucket kind of touches on this, but there's also the folks that aren't market makers, but maybe act like them or might have trading behavior. Like, just because you're a liquidity provider doesn't mean you aren't a taker, doesn't mean that you aren't necessarily making. Like, is this at all kind of a accurate statement?
Yeah, I think so. I mean, there are a couple of different ways to parse that, but certainly you can provide liquidity. You can lay bids and offers in the market without being a registered or appointed market maker. Conversely, by the way, I think every market maker, I don't even need to say I think, certainly every market maker is a liquidity taker at times, when, you know, either from a hedging or rebalancing or risk management perspective, or because price dictates. Like, yeah, I'm trying to vend a 2-sided market, but he's in between, and I think that's cheap, and I'm going to lift his offer. So yeah, I mean, they're kind of soft, sort of squishy lines all around. Is that what you're getting at?
Yeah. Well, I mean, just you said it great. Like, the lines are not clear cut anymore. Right. The roles, the delineations feel like they're not out the window, but they got, you know, 1 foot on each side of the fence. Is there anything that you would add to that from an exchange side of things?
I mean, I guess when I think about market makers, I think about, and my team talks about it a lot too, right? I think there are 3 tiers of market makers, right? You've got the large market makers, you've got kind of the mid-tier market makers, and kind of the smallish market makers, right? That could be just a firm that doesn't have a vast resources or a sizable presence. But again, to Steve's point, right, they still perform a function within the derivatives ecosystem. And I think what we've seen over time, right, as you'd expect, as the situation gets more difficult, more complex, and quoting and providing liquidity becomes more complex. Yeah. I think you see fewer and fewer participants sitting in that bottom tier, right? I think inevitably there's been consolidation within the market making community. I think there'll very likely continue to be consolidation within the market making community. And I think, you know, the large firms are going to get bigger, and I think everyone has aspirations to get to that top tier, but it's not going to be a fit for everyone. That's the reality of the situation, right?
Well, you touched on the consolidation thing, and we alluded to this, so let's just get into it. All of these kind of larger firms that you guys are referring to, CTC included, all have decades-long history that is based probably with founders that were on the floor.
Yes.
And so despite the fact that everything's all electronic and stuff now, it's like there is this kind of shared legacy-ish, and you don't see a ton of brand spanking new folks. I mean, maybe they're newish to options. They're not new, or they're new to options, but it's all former options people from one of the other big firms that like gets into it. So what's left to consolidate? Like what do you see a space where there's like more of these kind of like specialist people? Like, I don't even know. I'm just, what's the future look like for?
Well, I'll kick off there, and I'm sure Andy has a lot to add, but I mean, it would have been totally fair to ask that question last month. And then we saw Citadel scoop up the assets of Morgan Stanley as a market maker, right? Including their appointments on this exchange. So, consolidation continues, even the big guys. And by the way, that the Morgan Stanley story, I mean, it sort of caps a trend that we've seen over the last, well, since Volcker. When was that, 2009?
Post GFC, everybody ditching their
right. All the banks one by one. So when I was CEO at the Amex, we had a consortium of banks and broker dealers that were market makers that bought half of the business. NYC bought the other half. And Citi was in there, and UBS and Goldman, right? So we had the banks were meaningful liquidity. Barclays, the banks were meaningful liquidity providers in the options market. Morgan Stanley was the last one. Citi exited a couple of years ago. Barclays sold the GTS, right? You can go on back. So all those guys now are out. So even at the level of large, well-capitalized institutions, for one reason or another, Goldman Sachs, it was the old Hull trading business.
Yeah.
It was Blair Hull's business. They bought that from him in 1999. Long track record, incredibly successful. In 2010, well, I'll cut my own story short, but I remember having a conversation with a very senior person at Citadel who I won't name. That's where I censor myself. And basically saying like, yeah, we see our job as being to like go after Goldman. Well, good job, Citadel. You went after Goldman. And
mission accomplished.
and obviously great respect for people I knew at Goldman and Citadel as well. But yeah, so the landscape has changed. It's really, really hard for small players. I mean, not to go back to the Spice Girls era, but there was a time when a guy or a couple of guys would get together and say, okay, let's start a shop. That is where CTC came from. It was 5 guys trading on the floor of the Cboe in the SPX pit. And that was actually the name of the company briefly, 5 guys trading. That's almost impossible to imagine now without massive backing, because you're right. The new entrants that we're seeing, and it is good and healthy that we have new competition, but it's, Jane Street built up a huge options business over the last handful of years. Great company, brilliant people, not like a couple of scrappy guys, though, working in the garage, right? When they're getting into the options market. It's something that financial companies do as like their 5th thing. Now, after they've already built up, XTX was public about trying to get into the options market. They're massively successful company, right? Those are the ones who were saying like, hey, okay, now we're ready. Now we're ready to get into this options space.
And then
you mentioned it previously, right? And it is very much the case, like Steve alluded to, right? You've got firms that have cut their teeth in the markets for years, if not decades in some instances, right? And maybe they haven't been options or index market makers. That hasn't been really a strategic focus for them. But now, with the growth that we've seen in SPX, Erudite, a few others, but that's where there's opportunity, and that's where I think there's growth and opportunity for those that, again, these are pretty mature firms that are just leaning into the option space more than they historically have.
And I mean, I've read a few things, not my perspective, but that then they have an even different kind of way to operate in the markets. Maybe because they've got a giant equities business, they've got something else, some other information or signal or whatever, and so it's like, it's a different way, what'd you build first and then what do you add on later could potentially fundamentally impact the way you go about this business, what bucket you fall into or what have you. While I've got you, it's like that 50 minutes just flies by. We've been talking specifically about options, but that's not the only thing you all operate in. Is there anything worth being said? Hard to do in 2 minutes, but about the distinctions between, that's a whole nother podcast. Maybe not. Let's just end there. No. But
well, what I would be curious about though, and this is a question I often ask myself, and I deal with the likes of you all the time, right? How do you guys view the utility that the floor provides, and how is that accretive to the overall electronic market making business that CTC is involved?
Yeah, that's a great question. So you've given me a chance earlier. I glossed over this, and I said maybe we'll come back to it.
And here we are. We're coming back.
So I'll name check an old friend of mine in the business, Todd Holman, who you probably know. We did a panel together at FIA and OIC used to have, or OCC used to have a joint conference in New York every year in the fall. At some point that went by the wayside, but we did a panel together in 2010. At the time I was at NYSE, where among other things, I was overseeing our two trading floors in New York and in San Francisco, where we had the ARCA floor. And he went on record as saying, the floors are going to be gone in 5 years. And it's the only thing Todd's ever been wrong about, I think, in regards to trading. He's a very brilliant, successful guy, but and an old friend. But I think people have been calling for the death of the floors since certainly since I got into the business. Right, electronic trading is around the corner. It's going to take over, and then this transition happened that was spoke about earlier with ICE, Cboe, and others. Now you got me saying ICE, ISE, now part of NASDAQ. ISE, Cboe, and others adding the electronic layer. And I think, okay, well, the floor is going to be obsolete. And then time went on and that didn't happen, but it was going to be this. It's QCC, the qualified contingent cross order, where the floor doesn't have a chance to participate, which was a shame. But that's been the fact of life now since 2009. Kind of one thing after another. The floor is going to go away. Floor hasn't gone away. So certainly my view, our view, I'd be interested to hear your perspective. I'm guessing your perspective is not going to be that the floor is, useless, but but I'd like to hear you say it. But certainly
a vote of confidence.
Our view is floors are an important way to provide another way for those larger, more complicated, strategic orders to get filled. And we're seeing now a resurgence, products like longer dated options in S&Ps, products like the Flex family of products, which can be traded on most floors electronically or on floors in outcry. We've seen a couple of years ago for the first time in, was it the first time in 40 years, Box opened a new trading floor in this building, giving this building the unique distinction of being the only place in the world, I think, where two different competing companies operate.
That's a fun fact.
Floors.
Yeah.
You can make
MyX Sapphire soon to come.
And I was just going to say, MyX Sapphire's next. So we're actually seeing growth in the space, which again, 15 years ago, if somebody said, in 2025, there are going to be more trading floors, more exchanges are going to be opening these floors. I think that would have been a surprising development. So clearly the value add is still there. Now there is a market structure.
As with everything,
some details there, right? But we can get into where sometimes more isn't better, and the reasons for that. And I happen to think, I'm sorry, I can't stop myself, so I will expand on that point. I happen to think that SPX, and this is not just because I like you guys and I'm sitting here and we're the Chicago Trading Company, but I believe that SPX and CME also, by the way, has some similar products that I think are equally efficient, but as a product that trades in one place in open outcry where there's one venue, everyone is standing in the same spot. There's live competition happening among multiple firms. No one can go venue shopping, right? Nobody can take an order and say I think those guys might be a little too competitive. I'm going to try to take it somewhere else where I think I can charge both sides of my own ticket, right? Nobody can do that in SPX. And I think that's a very healthy fact. It's not necessarily true of every product. But nonetheless, sorry, that was a long answer to a quick topic. I think the floor is going to be around for a long time.
I can just attack onto what you said, right? I think from our perspective, as long as the floor provides utility, and it certainly does provide utility, and I don't see any reason to think that it would change in any way, shape, or form. So, as long as it's providing the utility that the investors trading in our products are looking for, we'll continue to operate it. So.
You guys have put your money where your mouth is too, right? Because during COVID, for a while, the floors closed.
Yeah.
And you saw we were able to operate the market collectively. Sure. But there was value in bringing it back, and that's what you chose to do, and every exchange chose to do. So, we've seen it both ways. But I think it's good for the market.
As always, our required housekeeping items. The views and opinions expressed by the host and guest of this podcast do not necessarily reflect those of Cboe Global Markets and are for informational purposes only. They should not be construed as financial advice. There are significant risks associated with transacting in all of the financial instruments described herein. It is very important for market participants to understand their own risk tolerances. To review all relevant disclosures and disclaimers, please visit us at www.cboe.com/global global-disclaimers. Again, www.cboe.com/global-disclaimers.